Bitcoin is one of the very few investments that haven't been budged exponentially by the coronavirus pandemic, and it is not so difficult to understand why. 1. There's the factor of scarcity. Just 21 million Bitcoin tokens can be mined, which makes a degree of scarcity that pushes up the worth of these tokens. Another explanation Bitcoin has done so well in such tough times is the prediction of a digital revolution. This is to say that Bitcoin investors have accepted the rocky nature of the utility of paper cash. This can somewhat be proven accurate by the potential of cash to be contaminated into being a transporter of viruses and germs. And lastly, Bitcoin also profits from its first mover advantage in the digital currency space. It was the primary digital currency to catch the eye of investors and turns out to be the biggest on a market cap premise by a critical sum. It's multiple times the size of Ethereum, the second biggest digital currency by market cap. However, as everything else has its pros and cons and supporters and haters alike, cryptocurrency too has its shares of negatives, which we will highlight in today's video. 10 reasons Bitcoin is a terrible investment. Before we begin the video, please subscribe to our channel and don't forget to press the bell icon to never miss another video of the future millennia. With that out of the way, let's get straight into the video. Number 10. Not as scarce as portrayed. Scarcity is the number one factor which adds to the value of a commodity. Bitcoin is just pretty much as scant as its programming directs. While actual metals like gold and silver are restricted by how much is actually available to be extracted from the earth, Bitcoin is merely restricted by programming and programming alone. And so, Bitcoin merely offers the view of shortage without actually being scarce. Number 9. It carries a low barrier to entry. Although Bitcoin may at this time be reveling in its all-time hyped first mover advantage, however, the hindrance for new currencies and companies to emerge in the cryptographic money space is particularly low. What this means is all that is required to enter the market successfully is to invest time and to have an average knowledge of coding for blockchain. That is the computerized and decentralized record that records exchanges and transactions. With this, you can then tether a digital token to the network. There's nothing really one of a kind about Bitcoin's fundamental blockchain that different organizations wouldn't be able to one up. Number 8. Minimal utility. The overhyped lord of cryptographic currency additionally has a utility issue. Up till now, just 18.51 million Bitcoin tokens are available to us, with an expected 40% of these held by a small group of powerful investors. In any event, even if we consider that fractional token ownership exists, a mere 10 to 11 million tokens available for use can't go too far. To understand this, consider the fact that the worldwide GDP was $81 trillion in 2017. In the meantime, Bitcoin has roughly 114 to 125 billion in tokens unreservedly flowing and not held firmly by investors, and that bears witness to the negligible utility it possesses. Number 7. Value difficult to measure tangibly. Another essential problem with Bitcoin is that there is no tangible method in which it can be listed as an asset. For example, let's assume you need to purchase shares into a public company. You can carefully analyze its financial records such as income statements, balance sheets, etc., which would in turn help you make an educated and well-informed decision. With Bitcoin, there is no substantial information for investors to study and critically analyze, and so its value or utility cannot be measured in any tangible terms. Number 6. Fiat currencies may work on blockchain, which may minus the need of unreliable digital tokens. In actuality, when people are buying into Bitcoin, they are acquiring position in computerized tokens with zero ownership of the basic blockchain that lies underneath. To expand on this point, organizations are trying blockchain that is fastened to fiat monetary forms. For instance, MasterCard was granted a patent in July 2018 for linkage of blockchain-based resources to fiat cash sums. This suggests there may not be any requirement for a made-up computerized token to be utilized at all on blockchain networks in the future. Number 5. Plagued with fraud and theft. In no way, shape or form are digital currencies the lone resource to be hacked by criminals. However, there are substantial worries of serious nature that go hand in hand with Bitcoin trading. For example, beginner Bitcoin investors may not comprehend the need to store their tokens in a computerized wallet, consequently leaving them open and unguarded in the face of theft by hackers. Also, it's been speculated by various media sources that North Korea has gone to Bitcoin mining and theft to pipe cash into its isolated and lonesome economy. Bitcoin is usually seen as the currency of choice by criminals, as it largely cannot be tracked or traced back to them. Number 4. Blockchain is still very far away from being standardized. Another imminent problem with Bitcoin is the fact that blockchain is still years from acquiring genuine relevance. 3 years prior, when blockchain organizations and digital currency stocks were at an all-time high, it was to be expected that blockchain innovation would be immediately embraced. Little did investors anticipate the catch-22 that would emerge. In particular, no organizations will make the exorbitant and tedious change to blockchain without the innovation being comprehensively tried and tested, and further, not many organizations are willing to take this underlying jump toward testing the innovation to demonstrate its versatility. Number 3. The tax situation. On the off chance that you think filing your personal income taxes are a pain in the back, have a go at planning them in the wake of putting resources into or potentially utilizing Bitcoin in any exchange. The Internal Revenue Service demands that you should report capital gains and losses attached to financial activity. For instance, in the event that you purchase a Bitcoin token at $11,000, utilize a negligible portion of your Bitcoin to purchase another cell phone for $1,000, you'll need to figure out the worth of your Bitcoin utilized at the hour of the exchange and perceive capital gains and losses comparatively with your cost basis. Believe us, it's not a fun road to take. Number 2. Lax regulation. Bitcoin is additionally an unregulated asset. However, this absence of regulations is really a selling point for the present crypto investors, given that it gives some level of obscurity. However, it's terrible news if something at any point turns out badly. Since most of cryptographic money exchanges happen outside the lines of the United States, the Securities and Exchange Commission is exceptionally restricted in what it can do if your computerized tokens at any point become subject to theft or fraud. Number 1. All too good to be true bubbles eventually burst. Regardless of how excited financial backers are about Bitcoin and its mysterious blockchain, history teaches us that it will not be sufficient to sit well on its present great expectations. We've effectively seen various 80,000 plus decreases in Bitcoin since its commencement. Outrageous unpredictability is a given with digital currencies like Bitcoin, and history would recommend that critical drop from its present cost is almost a confirmed future happening. With that, we end today's video wherein you were told the 10 reasons why Bitcoin is a terrible investment idea. If you have anything to add to our list, we'd love to hear from you in the comment section below. If you liked our video, do like, share, and subscribe to our channel. And don't forget to join us another time for another interesting video. Goodbye.